Did you see Leslie's on her way over? Kayla, what about you? Any international travels at all while at WIT?
At WIT, just a semester in Osaka, and then after WIT, 3 years back in Japan before going to Boston. So, yeah.
One of my student workers, she worked for me the 2 years before this, and she just graduated last May. She got, what was it? It was an award that she's now in Japan, and she's going to be teaching English, and
Yeah.
I'm just so excited for her. It was a dream come true. So
yeah, it was the best thing I could have done right after WIT. So good for her.
Good to hear. Well, it looks like it's 11:15, so we can go ahead and get started. Pete Franz today, class of 2004, CFA, which on the other hand would be like the gold standard in finance and investment, and CPA, like the black belt in accounting. So we've got the numbers guru with us today. Pete is a private wealth advisor with Beacon CFO, an investment platform consultant, and OCI, which means Outsourced Chief Investment Officer. He started his career in wealth management in 2007 and a member of investment committees for the Federated Church of CF and Greater Cleveland Habitat for Humanity and Foundation for the Parks. So when Pete isn't deep in the finance world, he likes to spend time with his wife, Molly, an 05 WIT grad. We've got a WIT couple here, and their 3 children, which I'm sure are all going to be future Tigers as well. And then their yellow lab, Charlie. He's an active coach and commissioner for CF Sports. Thank you so much, Pete. I've enjoyed getting to know him over this time of programming. I'm really excited for this presentation today. And I just want to thank everyone for joining us and celebrating homecoming in this virtual different world. We're still making the most of it. So I'm glad to see you all here. And if you weren't in the room earlier when we mentioned, we will have this recorded. So once you're just like, oh my goodness, Pete blew my mind today, everybody needs to know about investing young. It'll be up on the homecoming webpage, archived there. So feel free to share that and check that out. All right, Pete, I'm gonna share my screen and you can go ahead and take it away.
All right, thanks. Yeah, thanks for the opportunity and just to be a part of like any kind of Wittenberg stuff is cool, and it's been, these Zoom things are weird. I'm a sort of people person, so seeing people in the flesh, but like we've all had to adjust. So I'm glad that you reached out, Rebecca, and it's been interesting that in the last handful of years, I've gotten to sort of connect it with the investment club that they have there, and we did the Tiger Tank this past year, actually right before they shut down the world. There's a lot of stuff going on there, and so it's cool to be able to be involved. And I think we all have a lot of stuff going on, but I think like Rebecca said, like so my wife and I met there, so we have a strong connection. But there's also my sister's on this call. She was 06, and Molly's brother was a couple years ahead of us, 2002, and both sets of our parents were 72, 73. So we literally always joke like neither of us would exist. Our kids, not only would our kids not exist, we wouldn't exist if it wasn't for Wittenberg, right? So, and rumor has it that it was Baldwin Wallace Wittenberg back in the 70s, like 75 or like in the 80s. In the 70s, was a big rivalry, but we had aunts and uncles and grandparents that went to BW and Witt, and so it was a big rivalry. And it was the fall of 1984, and Molly was 3 and I was 4, and we met at Baldwin Wallace College at a football game because our parents ran into each other, and moms knew each other really well. They were Delta Gamma. So, anyways, we like the place, and when people ask us to do stuff, we're happy to say yes. So. I was just telling Rebecca, it's like a pretty fall day. I always think of football and Fincham, and I probably will for the rest of my life on a fall day like this. So, so listen, I like investing. I like wealth management. I like talking about portfolios and how you construct them, and I like talking about, like Rebecca said, I have a CFA, so it says on paper that I know what I'm talking about when it comes to portfolio construction and how you look at asset classes and how you manage money, right? And then I got a CFP, which is a planner's designation. It says I know how to help you figure out your balance sheet, your cash flow, your taxes, your insurance, all these different elements. So on paper, I always say that, full disclosure, like I know what I'm talking about. Then everyone's got to be a judge for themselves once they get to know me, but that's a whole different issue. So I was asked to talk about investing young, and Rebecca, if you want to go to the slideshow, which in full disclosure, I came up with a couple ideas and she made a really good deck. And then I said, I don't even know how to really share my screen, so I'm gonna let you do that part too. But we'll go to we can share our screen with this. I'll let you do that, Rebecca, and then we can work through these slides. But there's some basic concepts that I was gonna just walk through when it comes to investing.
I'm working on sharing those. I had to update
right.
that.
Yeah, it's fine. So the basic concepts in the first slide will show that. But like, there's some other key components, and I guess some of these are the first slide that says, hey, you got to say the younger you are when you save, the better, because time is on your side, because the stock market theoretically goes up, up, and up, and up, right? And that doesn't mean it always goes up. It means it goes up over time. And I just did this as a simple, financial calculator, press some buttons like time value of money, right? So if I save $100, I just use this as a starting point. $100 a month at age 20, so for 45 years to age 65, it turns into $275,000, right? So then I fast forward. If I didn't start saving to 35, I have to almost triple that amount of money, right? The second bullet, 35, the same rate of return. We could debate that, whether that's legit or not. But I essentially take that 30 at 45 years and turn it into 30. What do I have to do to get to the same dollar amount? And then if I wait until I'm 50, which by the way happens, right? That 50 is like, hey, I'm finally done. All these kids are out of my house. I've funded college. Now I can actually start saving for retirement. that's not normal or even bad, right? It's not good or bad. It just is what it is. But I literally have to save 10 times the amount over that last. So the time is a third, 15 years instead of 45. But I have to save 10 times the amount because, like, as you know, this sort of compounding effect just gets going, right? So that's a pretty dramatic difference if I can save 100 versus a 275 versus 1,000. Like that's a big difference, right? So earlier in the call, my little sister was teasing me, like that's what we've sort of done as we, she and I or our other clients, like well, I guess a lot of the clients I work with, like saving $100 a month is a moot point, like they're business owners or whatever. But there's a couple ways to look at this. One is whether you're in sales and have big commissions months and nothing some months, or you're an employee in a 9-to-5 model and you have a salary that has slight increases, or you're something in between or nothing like that, or self-employed or whatever. I think the concept is to save, something every month. And some people, I get it, like, and I'm frankly more of the mindset that says, like, I have a business, I have partners, I have actually a couple of different things I do. My income is not monthly. It's actually not even monthly. It's I won't get into it, but it makes some of these things harder. But the principle is like, hey, there's something I could do on a monthly basis. If I can't save anything on a monthly basis as a graduate of Wittenberg, I should probably, continue to work towards excelling where I'm at in my career. But if you could, again, $100 a month is a cable bill. Not actually, I shouldn't use that as an example anymore. Half the people in the world don't even have cable. But so that's the first slide. Like, it just shows the power of time and what you can do with those dollars. And I think that's important. So the next slide, is more around how a lot of people think it's important what you invest in. And I guess this slide says, no, it's not. And that sounds a little crazy, but the asset, like the specific, a lot of people think it's like, hey, so one of the big obstacles to saving or saving and investing, right? So there's a couple interesting points about that. I assume 6.25%. That's not pulled out of nowhere. That's sort of, if I invested in a moderately aggressive portfolio, which means 70% equities and 30% fixed income, or 75-25, whatever, I could get a 6 or 7% rate of return over a 15 or 30 or certainly 45 years. And that's just based on historical returns, right? So that just says, I got to be moderately aggressive, and then I pick asset classes. Sort of that's so the slide on the blue pie, the one on the left is this asset class selection, and that just says if I picked something like this pie on the right and was diversified, and I invested in U.S. stocks and U.S. bonds and emerging market stocks and developing market stocks and some commodities as a diversifier and some emerging market. If I had a diversified portfolio, globally diversified, stocks and bonds, and nothing that was overly aggressive or I'm not over allocating. And again, I'm not going to get too far into details. I could probably get a 6 or 7% rate of return over a long period of time. And that doesn't mean I got to pick the right mutual fund or stock or any of that stuff. I just have to I could buy the S&P 500 and the Barclays aggregate bond and emerging markets, and these are easy sort of ETFs or indices or ABC mutual fund. I could probably do that in 3 or 4 or 5 different ticker symbols and line items in my 401k or my Vanguard brokerage account, and have a diversified portfolio and not really mess with it ever. And just keep saving that monthly amount, and I could end up with a pretty big bucket of money, right? So I think the point of this slide for me was a lot of people don't invest because they don't know what to invest in, or they do invest and they basically shoot themselves in the foot by trying to outsmart the marketplace, right? And say, I like this or that. For example, like one of the slices in the pie there, take that US small cap stops, the orange one. That's something that does usually really good or really bad. Or another one would be like the emerging market stocks, the green slice. So they have a good year and a great year and a bad year, right? And so people usually buy those right after they had the good year. Actually, they buy them after they had a great year. They're like, oh, I like that. I look at the world of things to buy. I see what just did great, and I buy that, which is exactly the opposite of what because the sequence of returns never occur in order. And the best bet of something that just did bad, our best bet is something that's going to do good is something that just did bad, and vice versa, right? So that would be actually, if I was going to buy something, I'd buy something that's done bad recently. And if I was going to sell something, I should sell something that's just done good. But human nature says to do the exact opposite of that. And the reality is I don't actually know if that's going to pan out or not, because I have no idea where the world's going tomorrow or the next day, or with the president's election or COVID case or whatever. So I actually take all that out and I say, hey, I got to have a globally diversified portfolio in an efficient way. And I'm going to, and then I'm just really worried about the savings rate, right? So I'm saving that $100 or $1,000 or whatever it is, right? Which is actually something that should be proportionate to the amount of money that you're making. We'll get there in a second. So don't not invest because you don't know what to buy. If you don't know what to buy, send me an email. I'll tell you, here's like buy this and this and this or whatever. But don't not invest because you don't know what to buy, and don't put it in cash, by the way. So you should always have some cash. Everyone should have some cash. Cash is great, especially when, COVID hits and it's March and the world blows, the market goes down and can't find toilet paper. Like, cash is good, but if you have $1 and 80 cents of that is cash out of your total net worth, the problem with cash is you're slowly losing money all the time. You don't feel it because but there's this thing called inflation. So $1 today is going to be worth 98 cents a year or two from now. So I didn't know that, I lost 2%. And you could argue and peel apart inflation in a bunch of different ways. But theoretically, owning cash or having money in jars in the backyard or whatever, like, makes you feel safe, and you should have some, but it should represent 5 or 10 or maybe up to 15% of your total bucket of money, not inversely, like almost all of it. So I've kind of worn those two slides. All right, so we're going to go to the next slide. And this one is about, if you'll see, there's a little slides there, market timing. Market timing is the other thing. So people do make two issues in that sort of savings decision. So the first decision is save young, because the longer you save, the better the market compounds against itself. The less I have to save early. So I could save $100 a month over a 45-year period, or $1,000 a month over a 15-year period. That's a pretty big difference. The second decision around is, hey, what do I invest in? Invest in the market. And the third one is, don't try and figure out when the market's going to go up or down, because you're going to lose. It's like Vegas. I always tell people, picking stuff, whether it's picking the fund or picking the timing of the market. Like, I have friends, they go to Vegas 10 times. I only hear about the 1 or 2 times they won money. I don't hear about the 8 times they lost, right? So if you talk to people at the country club or at the XYZ event, if you talk to people about how they're investing, they're not going to tell you about the losses. They're going to tell you about the wins. They're going to say, oh yeah, I bought Apple 10 years ago. They didn't tell you about the 3 companies they bought that don't exist anymore. They told you about the one that did. By the way, Apple is a great example, crushed it and still didn't make up for the losses that they had, right? So again, this is just, if you invested in US stocks, right? So if you just bought the US stock market, which is essentially the S&P 500, right? Call it the S&P 500, and let it ride. This is, I think it's 10 grand. I should know. Yeah. So $1,000. Here's $1,000 over 50 years. And I turned it in, it turned into 120 grand, right? Now, guys, granted, all these slides, they sort of cherry pick timing, but that's the last 50 years. Last 50 years, the market's gone crazy. So it's grown a lot, but it's, it doubles and it doubles and it doubles and it doubles, and the market's up, 10 times in that period. So if I just bought the market and let it ride, this is the green bar. And then if you take the best performing day out of there, just one day, if you missed one day because you said, oh, I don't like how things are going to look, you literally are down, 13 grand, 12% or whatever, 10%. And then if you take out the best 5 days, so this is what happened. If you try to time the market and you work down this graph here, you went from being up 120 times to being up 26 times. Now, by the way, it's not horrible over a 50-year period. Taking $1,000 and turn it into, 26 grand. Certainly didn't do that with cash. But if you just missed 25 days over that 50-year period, right, which is only, a day every other year, you dramatically change the results. And if you click to the next slide, Rebecca, the reason that anyone would do that is because they think they've got some, there's some reason why they think that the market's going to turn. And I won't walk you through all this, and you'll see this, the reference here is Australia. So one of these questions here is number 10, what is the RBA doing? So that would be obviously the Royal Bank of Australia, which is like the Fed or whatever. So, but what happens is there's a couple things people are deathly afraid of, and it's not death. It's like public speaking and running out of money. And so we become emotionally engaged in the decisions, in what's happening with our money. And my advice would be to not do that, right? So if you believe that the market over your lifetime is going to be higher at the end than it is now, and unless you have better ideas, and if that's the case, over the next, most people on this call are younger than me, if the next 20, 30, 40 years, you think something with capitalism and the fundamental infrastructure of the world as we know it today is going to change so dramatically that the stock markets around the world will cease to exist or cease to be productive. Like, that's a different, I don't have the answer for that. I'm not creative enough to know. I think that there's things that have happened over the last 100+ years that if we looked back at them, we'd say, oh God, like if the world 100 years ago knew the world was going to look like now, they'd be mortified and amazed at the same time, right? So 50 years from now, right, when we're all old, what will the world look like? We have no idea. Will it be dramatically different? Absolutely. Will the human spirit of entrepreneurship and evolution continue to sort of that drum? Will that beat? Like, I say yes. If it doesn't, I don't know. We're a socialist society, or we're not existing anymore because seawater rate rose 10 feet and we're all dead, or whatever it is. I can't plan for that. I can plan for and continuing evolution of the human spirit. We're problem solvers. We have the ability to make decisions and adjust the way we think. Those things make us different from animals, and that makes me optimistic, even in as weird a year as 2020. So, but you can see along this chart and it kind of goes back to something I said earlier. When it feels really bad, so in March, the world stopped, literally stopped, and the market went down top to bottom. I can't remember. I try and like blank that stuff out, like 30%. It was pretty dramatic. The S&P 500 down, and in international markets down 30%. So it was March 18th or something this year that the market from like late February as this thing started. It was a very dramatic and very fast. So in the beginning of the year, the markets were hitting record highs, which by the way, they talk about that as like something that's amazing. Theoretically, the market will always be hitting record highs because the market doesn't, because it goes forward, it goes up. So all throughout the history of the market, they've been saying how crazy it is that we're hitting record highs, but theoretically, the market that moves up at a compounded rate will always be hitting. I digress. That's a different opinion. So that's a media thing we can talk about later. But the markets were at all-time highs, and it felt good to want to buy something, right? To like, hey, I'm buying in, and this feels good because like things are up, right? But if you think about it like a car, like, hey, this car's never costed more. You want to buy it? Oh no, that sounds stupid. Why would I buy something when it's the highest it's ever been, right? And the inverse is true in March. Fast forward a month from February to March, the inverse is true when I'm at the bottom. So the whole world stops and COVID, it's scary. Like, I don't know what's going to happen. And this thing bottoms out. And it doesn't mean we won't go below that with an election and a COVID flare up or who the heck knows what's going to happen. But it bottoms in March, the middle of March, like the 18th, 19th, and nobody really felt good about buying anything then, except for people who can completely detach, right? So at that point, there all of a sudden is a premium or discount, right? So that's when that same car, so the car cost $8,000 last year, it moved up to 10 grand, and then it would move back down to 7 grand. But when do you want to buy that car? I want to buy when it's 7 grand. But nobody does that because I don't know what this COVID thing's going to do. And I always have been lucky enough. I always have a few clients that they're like, hey, I got cash. I want to give it to you right now. The market's, it might go down more from here, but it's certainly cheaper than it was, right? And I always think that's, so part of having that sort of 10 or 15% cash is so you could take 5 of it and push it into the market when the market's down, right? So you always want to have some emergency cash and ramen noodles and, an arsenal, I suppose, if you're into that, because I don't know what's going to happen. When people say like, hey, what if the whole world goes? Like, I don't know. I don't have a bunker, so I'm not sure, but I have friends that do. So I guess I go to their house, but if things fundamentally change forever, all at once, 2007 and 8, people thought that was going to happen. This spring, people thought that was going to happen. I don't have a playbook for that. No one does, right? And it's funny because people always buy gold. And gold is like a soft metal that you can't make arrows out of and doesn't really have any value except for it's shiny. And we don't even use it as our monetary backing system as much anymore. So anyways, people buy gold and gold goes up, but I don't know why they do. But if things fundamentally change forever overnight, right? Because things are always fundamentally changing, but it happens slowly. Then I don't know what to do. But if assuming that the world sort of reverts to a mean operating procedure and people are making things and people are buying things and people are trading things and the globe is spreading out and growing, then there's a reason to have faith in this sort of consumer spending model that is in America and China and drives the market. By the way, there's like 7 billion people in the world and it's going to cap out at like 11 billion, and that's like 50 years from now. So for the purpose of our lifetime, that's not a bad model to invest in. If you might not like that, but that's different than something that you can make money on. So I'm not saying you should outwardly look to buy, cigarette companies, but that's a different thing about investing. Actually, Eric and I were talking about that. How do you buy socially responsible stuff, or ESG, the environment and social and governance friendly things? But that's, again, another conversation for another day. So if I'm looking at these slides sort of in reviewing, and again, I can go off on all kinds of tangents. It's save early, save often, because time value of money is on your side. Detach from what it is that you're buying so that you don't get so married to, I like this fund or that fund, or these funds just did good, so I'm going to buy them. I remember distinctly looking at a young client's 401k 20 years, or this is 10, 12 years ago. The market had just crashed in 7 and 8 and 9, and then this was like 10, And it was all the most volatile things that had just done really good over the last year. And he was like loaded up in them. And I'm like, well, why'd you buy these? He's like, well, they just did great. And I'm like, that's not, got to spread out. So I don't care what you're buying, as long as you're invested. Buy the S&P 500, buy global equities, just buy it and do it consistently. And then don't let your strong emotional, political, environmental opinions deter you from in the moment, or the fear of a moment, like we could, theoretically argue for right now or whatever. Don't let that make you try and time the markets up. It's impossible to do consistently. It's a two-headed monster. When to get out, by the way, when to get back in. And people, they actually they get it wrong on both sides usually. So those are things that can really hurt you. And what they do is they get it, then they're deterred from investing, right? Because you kind of double cross yourself. You were saving, you bought some stuff, you try to get fancy with what you were buying and or when to get in or out of the market. You have a negative experience, which can happen by just being in the market for periods of time early on. And then you're out. Then you just don't want to do it. Like, I'll just buy CDs, right? And the people I know right now who've been able to accumulate some wealth, baby boomers, who say they saved consistently, and they may think it's stuff that they bought, but it's the fact that they bought it in the stock market in the 70s, 80s, and 90s when this thing was going like that. And mostly, again, it does. And it wasn't what they bought, it was that they saved and that they bought that moved the needle. That's 97% of the equation, right? So again, some action steps here, right? And I know we got more time, we can answer questions or tell old stories or whatever, but save monthly, like count, and these are a couple of things, just some verbiage, right? And I probably threw out a bunch of different market lingo and industry stuff that if anyone has questions on, I'm happy to answer. But so save into a retirement account, which is a 401k or an IRA, or there's different sort of self-employed SEP IRAs. Save for retirement. The retirement account, or a qualified account, means tax advantaged, right? So if I save in my 401k, it's pre-tax on my paycheck. An IRA is pre-tax on my tax return, stuff like that. So have a tax advantaged savings and do that, arguably as much as you can, but make sure you're filling. That's one bucket. And then the other bucket is the non-qualified or after-tax savings. And again, that's sort of cash, but as you have enough cash to get you through a few months of life, cover your 2 or 3 or plus months of living, if you're whatever your budget is, and then you open a bucket that non-qualified after-tax investment, right? So you could invest it. You could open a Vanguard account. You could open up, brokerage account, whatever, and buy some things. And, that's, again, I don't care what you buy. So, but it's all about managing cash. So you have these 2 different buckets that you're going to open and add to and grow over the next 20, 40 years, so that when you get to retirement, you have theoretically Social Security or pension, depending on what line of work you're in, and you have a 401k or IRA, and you have this after-tax savings, because your Social Security and your IRA or 401k those are taxable. So every time you take $1, you have to pay tax on it. The non-qualified bucket, you pay tax along the way. So it's after-tax money. You pay tax along the way. If you take out $1, you get $1. You don't have to pay tax. That's important. And then have a budget. Like, it doesn't have to be, if you graduate from Wittenberg, you can build a spreadsheet that says what your monthly budget should look like. I'm convinced of that, because if I can do it, then anyone can do it. So it's literally 10 or 12 or 15 line items. It can be 30 or 40 if you want to get super OCD. But it's, hey, I've got, you got rent, you got groceries, you got, entertainment, and then some other miscellaneous bills. But and by the way, it should be probably less than you make. And then you should put things in there like, again, $100 a month for savings, right? So if I make X, it should be, my budget should be X minus, you know, it should be less than X and account for taxes. And then just force yourself to put some savings number in there. I don't care what it is. If it's $50 a month, you know, if you're saving, you know, $50 or $100 a month, it's actually relative, you know, and then it kind of pivots to the next one. Save something every month into the 401k retirement bucket and then into your cash after tax bucket that once it gets to be big enough, it spills over and you're saving and investing. And then that, like I said, that sort of pivots into percentages, right? So people think this is another sort of human nature. Well, $100 a month or $1,000 a month, and that's a lot or that's a little. And that doesn't matter. It doesn't matter. It all matters relative to what you make. If you make $1 million a year and save $1,000 a month, that's not that much, right? That's 1% if you add it up, 1.2%. If you make $100,000 a year and save $1,000 a month, that's great. That's 12%. That's 12 grand a year. That's 12% of your income, right? So if you make 40 or 50 grand a year and save, you know, $500 or $600 a month, $600 or $700 a month, which turns into, you know, 1,000 or, you know, 7, 8, 9, 10 grand a year, that's 15 or 20% of your income. That's a really good number. If you save 10 plus or minus 10% of your income for 30 or 40 years, you won't miss meals in retirement. And there's a big reason for that. Part of it is because you created a budget that after you lived off of roughly after tax, depending what tax bracket you're in, 60% of your income, right? So bear with me. I make $1. My income is $1. I pay 20 cents in taxes. I save 10% of that. I'm living off of fully 70% of that. Now, if I save 10% a year for 30 or 40 years and it's growing, I've got a bucket, right? And so, by the way, now I have 40 years of a certain lifestyle that's relative to my income. It's always 70% plus or minus. I haven't seen it yet where the 65-year-old retires. They lived off of 70% of their income, save it to 100 grand, 70 grand. And then all of a sudden they started living off of twice that because they went and bought they drove a Corolla, then they bought a Porsche. Nope, nobody does that. Maybe actually some people buy a fancy sports car first in retirement, but nobody like doubles we're creatures of habit. We become used to some level of lifestyle. And you just have withdrawal rates as percentages. And I always tease my mom, she's in an investment club, and she's like, we made $7 on this thing. And I'm like, what's that mean? Like, if you make $7 on a stock that was worth $8, like that's a lot of money. If you make $7 on Apple, that's at $130. That's not as impressive to me, right? So I always think in terms of percentages. I get it. I'm a little crazy. I don't think of things in the normal way. But then it's all relative because the whole thing is relative. And a millionaire today is not as cool as a millionaire 30 years ago. Not that it's not cool to be a millionaire, but a millionaire 30 years ago, that $1 million bought me a lot more stuff, right? The $1 million today, you know, kicks out 5% a year, 50 grand. That's cool. But that 50 grand, again, 50 grand 30 years ago, 50 grand a year was more money than it is today. So percentages and sort of conceptual, contextual growth rates and withdrawal rates, right? Because ultimately, the only reason we do any of this savings thing is because we have some objective of financial independence where I don't have to ring the bell on Monday morning. I don't have to answer to the man or woman. I don't have to do any of that. I can do what I want because I've created a lifestyle that's scaled appropriately to the amount of wealth I have. And I saved aggressively and I invested appropriately. And I say that sort of the stuff I bought and the proportions of it and what I paid for it. I saved well. I did good with how I invested that. And I use those words that are important. If I save nothing that's stupid, if I save like over aggressively and I never go out to eat and I skip all vacations in my 20s, 30s, 40s, and 50s because I'm saving like a freak, like I think that's silly too. That's more of a life coaching thing. But like if I save 10% a year for my 20s, 30s, 40s, and into my 50s, by the time I'm 60, I can make a lot of choices. And that's, to me, the whole point of like that. What are we trying to do here, right? And so everyone's got a different math problem around that. Again, if you make $1 million a year and you have a lifestyle that's 400 grand, that's different than the person who makes 100 grand a year and has a lifestyle that's based off of 60. And neither of those are right or wrong. But if you, by the way, if you need $400,000 a year, you better have a pot of 10 million bucks. So if you save 200 or 300 grand a year, then you're fine. If you save 20 or 30 grand a year, you're going to work forever. And it's all relative, right? And by the way, I've got wealthy people who don't save any money and they're going to have to work forever. And they got a couple million bucks, but they live off of hundreds of thousands. I've got wealthy people who don't spend any money. And they're the example that they saved super aggressively and had no fun. And they're super paranoid about money. They'll never have enough. And that's not good. And I've got sort of the people who, I think a lot of them, and I spend a lot of time talking to my clients about this stuff, is like, what are we trying to do here? What's the goal? Like, oh, well, I want to be able to travel some. Okay, so like, let's budget, let's build that. That means that dictates what we need. What we need dictates how much we have to save, how we want to invest it, and how much cash we keep on hand. And all those things, sort of documenting objectives, allocating cash flows. That's the planning, that's the CFP part. That stuff is way more manageable than kicking butt on my investment returns. And hey, I got 12% annualized. And I'm like, no, you didn't, if you get, the more you get, it's a equal pendulum swinging thing, right? There's upside and downside. And if I get more, I can lose more. And anybody who figures out how to game that, I want to talk to you because I don't think it's possible. And if it is, I'll do whatever you think it's doing. It's either illegal like Madoff or it's like a unicorn. It doesn't exist. So that's just my experience. But you can get 5, 6, 7% a year, if you give yourself a long enough time horizon, and you can manage your cash and you can manage your budget. And those are all things like, those are all sort of, if you're a young person looking to create a path towards financial independence, that's, save early, save often, don't get crazy with what you're buying, and don't try and time the market. Like whatever happens next month, this is my case in point, then I'll shut up. So I've talked to people who feel both sides of this whole political thing, right? So the elections always get people freaked out if you care about that kind of stuff. And I've talked to people who are Biden people or Trump people, and both sides have said, what should I do to prepare for the election if they take office, right? Or if they retain office? And I'm like, well, here's the deal. So if you're freaked out, what you're insinuating is that if they win, the thing will go down. Yeah. So then that means if you win, the thing will go up. Well, I don't know about that. Well, no, if one scenario dictates it down, then the other has to dictate it up. And if we don't know what's going to happen, then we can't make adjustments based on that, right? What we have is, do you need cash? Well, no, I have the cash I need, right? It's right, you do, because you got a good planner. And if you have a good planner, then you got the cash you need for the next year or 2 or 3. So if you have the cash you need, then we're not doing anything, because even if they win and it goes down, we're still going to have the cash we need for the next year or 2, and it will come back, right? Despite what you think. So your emotions are, and I get it, there's plenty of things to be scared about on either side if you believe those things that people on either side believe. So that's fine, but I don't allocate to that because I don't know who's going to win. And by the way, statistically, what we really want in America is what you really want maybe when I say you, if you're very liberal or very conservative, you would want all conservatives or all Democrats, and no, that's actually the only bad scenario if you look at it historically, is if it's all one or all the other in the House and the Senate and the Oval Office, then it's bad because things get jammed down anyways. That's the bad scenario for markets. So we don't want that. I don't know. That's all I could talk for the whole day about these different things. I think it's big emotional decisions. Emotions run a lot of these decisions, and they shouldn't, but they do. So it's important to spend time thinking about that stuff or seek professional advice so you don't have to be the decision maker. Anyways, that's all I got, Rebecca. I don't know if you want to open up questions or
yeah, let's open up the floor for if anybody has any questions at this point. That was wonderful. Thank you so much. I literally took a page of my notes myself, so I hope that it was valuable for everybody too. Questions?
Hey, Pete, it's Chris. Good to see you.
Hey, what's up, Chris?
Oh, not much. Thanks for having us this morning and sharing some stuff.
Yeah.
So my question, the age-old question of saving versus investing and cutting down debt and all that stuff. What are your general thoughts on how to balance priorities? You just, the Dave Ramsey, get rid of debt first before worrying about everything else.
Yeah.
Or just what are your general thoughts on that?
Yeah. So there's like again, think about these things as buckets, right? Like I got my debt bucket. And there's good debt and bad debt. I think debt that is there's a utility to debt. Car debt usually isn't bad. House debt's fine, depending on the rate. But and then like consumer debt's the no. Try not to let that rack up on you. And here's the other thing that's important. It's not a sin to have credit card balances, and it's not a sin to not be able to invest. Like life is not linear, despite what we think. So sometimes you just gotta let yourself off the hook. But if it's a rate question, right, Chris? So like, what's my rate? What am I paying? Again, on a house right now, you're paying 3 or 4% at the top. Like so paying that off faster is a little bit silly. And it's, what do I think I could do otherwise? So if I'm putting this, if I think my long-term expectation for $1 is 5, 6, 7%, anything less than that's not necessarily a good investment. Anything more than that is. So if I have consumer debt, credit card debt at 12 or 15%, like get rid of that. That's an instant savings of that percentage. But the other thing is, if you got $1, you have a decision matrix around like, where do I put that? Do I invest it? Do I put it in cash? Do I chunk down debt? And again, I think consumer debt's a no-brainer. If you're doing your monthly investment, then it makes that like, I don't have to push that, because there are times when you could, hey, I got an extra $1. It's March of 2020. Everything sucks. The world's going to end. I should invest a few of those dollars into the market, right? When it feels horrible. So there's some general parameters around rule of thumb, like what's the debt and what do I think I can get in the market, and then where's my cash? If I don't have 2 or 3 months of cash, I should keep that cash, right? Or I say 2 or 3 months. 2 or 3 months is the rule for young investors, right? If you're retired or about to retire, you should have 2 or 3 years. You should have a lot of cash. You should have enough cash to get you through, think about like the fall of 07 into 08, into the spring of 09. It was a 2-year cycle, sort of round trip. And you don't want to pull money out of your investments when the market's down 50%. You just turn $1 into 50 cents. It's fine as long as you don't sell out. And so you want to give yourself a little time to let that play itself out. So.
Makes sense.
Yep.
Yeah, I think that's good advice. And then Erica was wondering, and I echo this wonder, what bucket is student loan debt?
It depends where you work. Some of you work for a nonprofit, like a, WIT in a Peace Corps and so it depends on where you work and your confidence around that program being in place, because there's a 10-year forgiveness for student debt. And again, opinions on that don't matter. It's more, I don't have as much. I mean, Erica's kind of one of my sources because she's been working with the government in a couple of capacities. And actually on that Habitat board, we have a lot of people who apply for Habitat houses. And it's very clear, there could be someone who's making 30 grand and they owe 100 grand in debt, but they've been working at the Cleveland Clinic for the last 7 years. So we're like, they got 3 more years and that debt's forgiven. Mm-hmm. So I think that depends on what your line of business is, but it's higher rate. If, I think in general, student debt over the last 10 or 20 years to me looks like 5 and 6 and 7 and 8% debt, depending on where it's at. So I think you want to figure out where you are. If you are working for the government or some nonprofit and it's going to get forgiven, you just let that sucker accumulate. But then there's some feeling of like, I can't leave here, right? You got to think about what that means. But that's fine. Like, I think, what's the number of total debt? But it's a different bucket, certainly, because of the forgiveness element. The rate puts it into that sort of in between consumer debt and house debt. But it depends on what you're doing, what your vision is for what you're doing. And I think the good thing is there's a lot of jobs, and the Cleveland Clinic and UH up here are huge. It's so big. And the good thing is these doctors that have $400,000 of debt, theoretically it's forgiven, but that's the whole system. Again, discussion for another day. I think the education and the pricing of the education system is one of these things that we're evolving, and they're changing at a really fast pace in this environment. And I just don't think that WIT, as an example, is going to go from 50 to 25, but I don't think it's going to continue at the pace, right? I think it's going to change the experience and how you can bill for that. So Erica asked another question here, that like the platforms, like where do you go to open these? Like, I always say generically like Vanguard, but you can go anywhere. Like you can go to E-Trade, you can go to Vanguard, you can go to Fidelity. Like it's super easy, especially if you're a little tech savvy. Like the challenge a little bit is some of the vernacular that you might use, right? So like I've worked with people to set up Vanguard accounts, and I'm not techie, but they're not. They're like, what the heck does this mean? Like I'm like, oh, that's so. But there, some of the potential risk that people in my industry see is that there's all these tech platforms and robo advice, and it's easy, right? Once you get in, and that's not a threat in my opinion, but especially when you work with wealthier folks. But it's pretty easy, and it doesn't matter. And theoretically, it's a commodity. Pick Vanguard or Fidelity are the ones you hear about, and it should be relatively cheap. Like to open a Vanguard account and invest in Vanguard funds almost costs nothing. But you should always have but nothing costs nothing, by the way, right? You should always know what you're paying. Trading costs don't matter, because if any of you are trading, anyone listening to this call shouldn't be trading that much. I don't trade that much. We don't pay that much attention to those costs, but like internal expenses of funds, most of these Vanguard ones are so cheap, it's almost free. But some things can become really expensive, like annuities can be real expensive if you ever hear about annuities. So pay attention to that stuff. And that's, again, like just sort of, annuities are like a red flag word. Most people, a lot of people have them. A lot more people have them than need them, and they're expensive. But there's also a huge utility for some people. So, what's this, Erica? I heard Vanguard is close to a nonprofit as it exists. And how's that true? So they're not a nonprofit. There's no one in financial services, who's a nonprofit. If anything, it's the other way. But what they've done, what some of these big firms have done is they have so much scale, right? So do a math problem with your calculator and do, so 1% of $1 million is 10 grand, right? But 0.1% or 0.05%. So 5 basis points, which is 0.05%, right? So it's 1/20th of that. So that's like a Vanguard fund costs like 0.05%, but do that on $3 trillion, not $1 million. It's a big number, right? So it's a huge number. They just have a lot of assets. They manage a bucket that's it's bigger than $3 trillion is a lot of money. I gotta do it on this calculator just so I can, I don't even know if my calculator goes up to $1 trillion. Billion. Yeah, it's $5 billion, $50 billion. That's a lot of money. $50 billion is a lot of money. That's pretty good. That's not for profit, right? So, and I think they have about 2 or 3 trillion bucks, and their average cost of their fund is 5 bips. That's $50 billion. That's pretty good revenue, even if it's not dropping all to the bottom line. So
I think I heard it was like an NPR Life Kit podcast about investing. Not as good as today's Zoom call, but similar idea of like kind of the general stuff. And I think it might have been the guy who's in charge of Yale's endowment who has a pretty good track record. And so he was also suggesting Vanguard. And I think he said just like as far as accessible and really low fees and stuff, which is what you had also told me too.
Yeah, so Yale's not a great example, except it is, but they buy like timber tracts in Canada and they buy private debt and private real estate. So Yale's got a whole annual report that I read about how they're allocated. But everybody gets the market somewhere. So every endowment, even if they're big and fancy like Yale, that's a third or half in these alternative things and private equity and real estate, they still buy the market. And the best way to buy the market, there's efficient markets and non-efficient markets. And the S&P 500 is an example of efficient market. And small cap emerging markets would be an example of a not efficient market, where you might actually pay more for something that has some uniqueness to it, where you want specific managers who have an office in South Africa, so they understand the African market, right? But there's two different, there's paying for the investment in Vanguard or American funds or Fidelity or whatever, and then there's paying for the advice. And so my business is I get paid for the advice. And again, part of that's the investment advice, but the other part is your cash flow and your estate and your insurance and your tax and your future retirement and your investments. And so it's there becomes a time in life and or a certain net worth where it's pretty costly to not, unless you're an expert in those areas, to not have advice. So I like my chances in my business because I can charge people plus or minus 0.5% or 0.75% for the advice. Because if you're worth $10 million, that's a decent number, right? Call 50, like it can be a significant fee. But what's the cost of making a 2% error when you're worth $10 million? Or a tax filing error or a estate planning error. There's hundreds of thousands or even 7-figure numbers. So that's how we earn our fee, is we work with families that sort of see the advice as part of that. But I think it's the one thing I've realized over the years is that we do more. There's more going on than I sort of appreciate because I spend my life in it. When I talk to someone who's smart, and then I'm like, wait, they don't even know that? And I'm like, oh, I guess they that guy's building rocket ships. He's not managing his money. Like, it doesn't. And my clients, they don't want to know. Like, they're like, listen, I want to know that somebody's got this all figured out. I don't want to spend time. I don't want to spend time in it. I don't want to spend time in my checkbook every week. I don't want to spend time in my portfolio every month or quarter. I don't want to do that. I want to let you do it. And it's actually part of the financial freedom proposition, right? If financial freedom isn't just having the money you need to do what you want. It's actually not having to pay that much attention to it because somebody does that for you. So, Mark's asking why are not in annuities the best investment. I don't think, Mark, I think they're not good. I think you have to have good information, and Thrivent definitely has them. And, you know, my dad's on the Zoom call, they're listening. And he used Thrivent. Maybe they came to Wittenberg's campus back in the 70s because he had some Thrivent stuff. They're fine. They provide a guaranteed income element to people who, you know, are approaching retirement. They have costs to them. And my argument would be if the average annuity costs plus or minus 3%, and I can build portfolios with my fee included for less than half of that, call it 1% with the expense and my cost, that's 2% a year on every year forever. That's the difference, right? And if you annualize that, so that cost can become pretty significant, where I would say you take a Vanguard portfolio and just let it ride and manage your cash. You might be better off not being an annuity. But that, you know, that being said, I have clients and we utilize annuities because there's a value to the certainty of the income that those things kick out, right? So you're sort of saying, hey, I don't need to get more. I want to get income. I want to know that's coming. And so they're like everything else. They're not good or bad. They can be misused. And there's some, how's the nice way to say that? There's a misalignment of incentives sometimes, right? Based on how they're structured. People can have paid a lot of money to sell them. I've seen that happen. And here's the other thing is they're really popular at the exact wrong time. So like buy low, sell high. You should buy an annuity as you're going into a bull market, at the end of a bull market, when things are up. So I took $1, I turned it into $1.50. I should take that 50 cents, put it into annuity, playing with house money. But when most of them are sold is when $1 turns into 80 cents. And people are like, hey, we don't want to lose any more money. We should use an annuity. So they're sometimes missold. Yeah. So yeah, again, that's, you said, you know, look at some of the sold some of them out. So they're not good. There's a lot of info you would need. CPAs don't like them, but CPAs don't like anything. You know, they're super picky. They can be good or bad. Ultimately, it comes down to to me, the importance of my role as an advisor is that people like me and trust me because I'm a pro. I can say anything and spin stuff, and good advisors are good at talking, and they're hopefully professionally ethical. But, you know, I always joke with my lawyer buddies, like, you guys took law school and the bar, and we sat for a Series 7 test, which I passed with a poli-sci degree from Wittenberg after studying for like 6 weeks. So what the hell? Like, it's different levels of different levels. That's why there's advertising around CFA and CFP, is because ethics and standards are part of those things. So it makes it more like a legal designation. But we could keep going, but I got this sort of 12:15 time frame, and does anyone have anything else? So, Dad asked the question about, yeah, he had joined too late. Good comment, Erica. And what would the 3 lowest price? Yeah, we already talked about that. We'll send you the PowerPoint. We covered that stuff. Would you show up late to class in 1970 at Wittenberg? Would you show up late to class and ask a question? Actually, you probably would. Never mind. Sorry, we'll have a sidebar family discussion on that one.
Oh, thank you so much, Pete. That was entertaining, educational, all the above. yeah, I feel like I could ask so many more questions, but I'll call you offline sometime
Yeah,
and
call me,
we'll keep in
for
touch.
sure.
So thank you all for joining today and celebrating homecoming with us, and hopefully you'll stay tuned. There'll be more Alumni Tiger Talks like this and the alumni college presentations moving forward. So hope you all have a great rest of your day, and thank you, Pete. I'll be in touch.
Thanks, Rebecca. Take care, everybody.
Take
Thanks,
care.
Pete.
Thanks, Pete.
Thanks, Pete.